Today, we're unpacking a major shift happening across the Canadian rental market. Rents are falling. After years of skyrocketing costs and fierce competition, the data shows average asking rents across Canada have been decreasing for months now. In fact, average asking rent fell to just over $2,000 in December, and that's the lowest it's been for more than 2 years. In this video, I'll explain what's behind this trend, why it matters right here in HRM, and what it means for renters, buyers, landlords, and investors. According to the latest national rent reports, average asking rents across Canada have been declining for 14 straight months, and most recently about 3.1% year over year in November to around $2,074 per month. And that marked the largest month-over-month drop seen in 2025. This trend, rare in the post-pandemic rental boom, reflects a broader softening of rents nationwide. Cities that once led the charge on price increase, like Vancouver and Toronto, are now seeing rents at their lowest levels in years. Experts say this isn't just seasonal slowdown. It's a sign the market is rebalancing after a period of intense pressure on supply and demand. So, what changed in 2025 to cause this shift? After years of record population increases, especially from newcomers, Canada has started to see a slowdown in immigration and migration trends. That means fewer new renters entering the market relative to the past few years. At the same time, there's been a surge in rental completions and housing starts. More units built than demand can immediately absorb. So when supply outpaces demand, landlords compete for tenants, which puts downward pressure on rents. These combined trends, slower net growth of new renters and a wave of new rental listings, are key reasons why we're seeing this extended rent decline. Now, you might be wondering, what does that mean here in Halifax? In the Halifax region, rents haven't dropped as sharply as in some major markets, but we're seeing signs of balance emerging. A 3.3% decline in Halifax is modest but meaningful. It suggests that local supply and demand pressures are starting to settle after years of tight competition and rising rent costs. Developers respond by building, and many of those cranes you see in the sky aren't for condos, but for rental units, adding much needed supply. And this falls right in line with the national trend where increased supply is reshaping affordability dynamics. And this is big news if you're renting or thinking about renting. With more units on the market and rents softening, renters now have more options, fewer households fighting for the same unit. Landlords are increasingly willing to negotiate lease terms, move-in dates, and rental rates, something that was nearly unheard of at the peak of the rental boom. Softening rents help bring pricing back closer to the pre-pandemic affordability levels and welcome shift for anyone feeling stretched by housing costs. Now, falling rents don't automatically mean falling home prices, but there's a connection that's worth understanding. Rent levels are often tied to broader supply-demand fundamentals. When rents soften, it can signal that demand pressures are easing, and that may eventually feed into slower home price growth. For buyers looking at investment properties, a softer rental market can impact expected cash flow and valuation. Investors monitor rent to price ratios closely, and if rent growth slows while property prices stay high, the potential return declines. So, even if you're buying a home to live in, this rent data tells us something about where the broader housing market is headed. For landlords and owners with rental units, with increased supply, tenants have more choices. That means units that aren't well priced, well presented, or well marketed could sit longer on the market. A well-kept property with modern finishes will attract tenants much faster than one that needs work and may still command better rent even in a softer market. So today's rental market rewards quality and responsiveness, especially as renters are more selective. So what's the bottom line? Across Canada, from Vancouver to Halifax, there's a rental market shift underway. After a long stretch of rising rents, we're seeing extended rent declines as supply increases and demand growth cools. For renters, that means more options and negotiating power. For buyers, it's a signal to watch broader fundamentals, but not something to overreact to. For investors and landlords, it's a reminder that quality and strategy matter, especially in a more balanced market. As with any market trend, it's important to stay informed and contextualize data within your own goals, whether you're renting, buying, selling, or investing. And on a personal note, I feel this too. My rent has gone up the maximum amount allowed over the past 4 years, and I am hopeful this cooling trend will affect my billing as well. God, I hope no increase next year, or at least not the max rate, right? If you found this video helpful, please share and drop a comment with your local experience. And don't forget to hit that like button and subscribe for more Halifax real estate insights. See you next time.